I'm going to share a simple but advanced multi-time frame trendline strategy that I've created from years of practice. I think you'll find it really helpful. If you're a beginner, watch my detailed trendline video with strategies first. The link is in the pinned comment. Now, let's get into the strategy. We start by using multiple time frames to get a clearer picture of the market. Here's how we can make the strategy more effective. We begin by looking at the daily time frame. Right now, the market is in a downtrend, and we've drawn a trend line by connecting key points. Along with this, there's a support level that we're watching. After the price broke below this support, it has now turned into resistance. What makes this setup even more interesting is that the trend line and the resistance level intersect at the same point, creating an area of confluence. This is a powerful signal because when multiple factors align at one level, it can indicate a stronger price reaction. As the price approaches this level, we can't predict with certainty what will happen next. While the big picture shows a downtrend, the short-term trend appears bullish. Before making any decisions, we need to see how the price reacts when it reaches this level. Right now, there's a shooting star candle, which often signals potential reversal or indecision in the market. This suggests that we should wait for confirmation before taking action. The next step is to draw a tighter trend line, similar to the one we've already drawn. However, with tight trend lines, there's always the risk of fake breakouts, where the price briefly moves past the trend line but quickly reverses. To avoid falling for this, we'll check the same chart on a lower time frame. On the left, we have the daily time frame, and on the right, the 4-hour time frame. The resistance line we saw on the daily chart is still visible on the 4-hour chart, showing consistency across time frames. We also see that the trend line on the daily matches with the trend line on the 4-hour chart. Now, let's focus on the mini trend lines. These mini trend lines may not look perfect on the daily chart, but when we switch to the lower time frame, they become much clearer and more accurate. This allows us to spot trends more easily and avoid fake breakouts. Now, the next step is to trade based on the lower time frame. We notice that the mini trend line has been broken and the price has dropped below the previous low. This confirms that the short-term uptrend is over. Given that the overall market is still in a downtrend, this is a good opportunity for a short trade. However, the breakout of the mini trend line alone isn't enough. The key point is that this breakout needs to be rejected after the price reaches the area of confluence we identified earlier. This rejection confirms the validity of the breakout and gives us more confidence in taking the trade. Once you've entered the trade, set a stop loss just above the resistance level or the last swing high to protect your trade if the market goes against you. For take profit, choose a clear target based on the trend, like the next support level or a key area where the price might reverse. Aim for a 1.3 risk-to-reward ratio and stick to your risk management rules. After the trade is active, watch the price carefully. If it moves in your favor, adjust the stop loss to break even when the price reaches halfway to your target. This locks in profits and lowers the chance of a loss. If you found this helpful, don't forget to subscribe. Want to learn another powerful strategy? Click here, and I'll see you in the next one.